Tracy, you went to Port Stanley this weekend? Yeah?
It was great.
How was the water? What temperature?
It was warm.
Yeah?
It wasn't too bad. Really sunny.
In the 70s maybe or so? Sure. You don't know, right? Just no worries. What'd you do, Phil?
I had a great weekend too. Went to Whistle Bear. Well, I didn't golf, but Mike and them golfed, and then we had dinner at Whistler, so it was nice. And then yesterday, kind of just chilled.
Chilled.
Yep, it was a chill day.
Whistle Bear is a great course. It's nice. It's good.
Yeah.
Port Stanley is a great beach. A lot of nice beaches in Ontario that we really don't pay a lot of attention to, but it's fantastic.
We must have had a very good, nice boating weekend.
It's a great weekend. Yeah. The lake was fantastic. The water was good. Water was 75, 76. We went all the way out to the lighthouse.
Wow.
Great Log Point Lighthouse.
Yep.
If I had gone around the point, I could have gone to Port Stanley. Another hour and a half later, though, let's run out of gas. Let's stranded. All that fun stuff. Awesome. Phil, thank you for joining us today.
Oh, well, thank you for having me, guys. This is awesome.
This is the podcast is called Collecting Compounders. This is the financial planning edition. We're going to be talking about Bank of Canada's recent rate decision, where we might think rates are going. Talk about the housing market, not so much real estate because we're not real estate professionals, and a little bit, obviously financial planning because this is the financial planning podcast for Collecting Compounders. But Phil, you're a mortgage specialist.
Yes.
You want to bio?
Yeah. Well, I work for Simpson Associates, Dominion Lending Centers National. I have two roles, really. I'm an underwriter for Dan Simpson, one of the most busy, mortgage brokers out in our industry here, and especially in our area. And I'm also a mortgage agent. I do my own mortgages on the side as well. So I'm a very busy lady. I do see a lot of files that come through my hand. So I do have a lot of experience. I've been doing mortgages since 1996. So
I was going to ask you that. 1996.
In 1996, back in my banking days. So I work for two big financial institutions. But now I'm in the broker world. I did the broker world. I started in 2015. And then worked for Dan Simpson in 2001.
Excellent. So 96, that's when I got started in my industry, wealth management.
Yeah.
So 27 years, correct?
Yeah.
Quick math. And Tracy, you're just a baby, but you actually have over a decade of experience as well.
Mm-hmm.
Do you want to just a little bio for those that don't know who you are?
So I'm a certified financial planner, and I work on the Marnoa team. I focus on the sandwich generation, so people who are caring for aging parents while raising their own children. And I've focused on life and living benefits insurance for over 10 years with another insurance company before joining Marnoa.
Or used to actually work together.
Yes. I did have a 4-year stint in insurance, which I'm surprised I even lasted that long in insurance. But I do love mortgages and kind of weaned myself back in there. But yeah, we had a great time together. We worked together. We were amazing.
Yep.
Yeah, dream team.
And the dream team is reunited for 20 minutes or so.
Yeah.
Awesome. So not too long ago, the Bank of Canada lowered its overnight rate by another 1/4 point, so 0.5% in total year to date. There's the expectations, not expectations, but there's a very good chance that they're going to cut another 25, 50 points by the end of the year. Mm-hmm. Right. In the mortgage world,
well,
what's been the impact?
So working for Dominion Lending Centers, we have our own chief economist. Her name is Dr. Sherry Cooper.
Yeah.
And we're very fortunate to have her. She's very insightful, keeps us updated on what's going on in the economy. And she has forecasted that this is just the beginning. So we started it was in June that they went down 1/4, and now in July, and we will continue. Now, we know that the Bank of Canada wants to keep it slow and steady because they don't want, to cut too deep because it may cause, they're trying to get those inflation numbers where they want it. I think at around 2%. Exactly. That's what they want to do. So our chief economist is expecting, like right now, it's 4.75 is the Bank of Canada rate. And she's forecasting maybe by the end of 2025 to be down to 2.75.
Oh, wow. Like, so another 200 points.
Yeah.
Going today.
Yeah. It could be because every single one, it could be 0.25%.
Yeah.
You don't know, but that's what she's, kind of forecasting.
Okay.
But we will see. It has a lot to do with their economy, really.
Yeah. And I kind of agree with her. I don't know how much it's going to be, but I've been saying this. We tell clients that, in our opinion, we feel that the Canadian economy is going to hit a wall, if it hasn't already.
Mm-hmm.
And the Bank of Canada will pretty much be forced to cut rates faster and harder rather than slower. Right. So we're definitely seeing that in certain industries, but it'll be interesting to see what happens.
Mm-hmm.
The one of the concerns is, we do what's called boots on the ground research, right? So we actually talk to our clients that are business owners and industry professionals and things like that. And the construction industry is definitely slowed down, right? Other than maybe industrial and institutional, the residential is definitely hit a wall, right? Single family homes are non-existent. New single family homes are non-existent. The condo market, we'll look at some articles and things like that, but especially in Toronto, Vancouver, it's a disaster, and developers are not putting shovels into the ground right now. Mm-hmm. Right, so that's going to create a whole other issue in a few years. But it's definitely interesting what's happening historically. Bank of Canada right now cut rates, but if we've been so used to, or anyone that's gone into real estate, or newer Canadians, even like the millennials as an example, they're just used to rates coming down. Mm-hmm. They've never been in a rising rate environment, and in 2022, rates actually started to go up. Right. What's the average? Actually, I have that. We could look at that. But how do your clients view today's rates? Like, do they feel like we have to get it lowered for housing affordability?
Yeah, it depends on who you talk to, right? So a lot of our clients, so they like older, if you're in your 40s or 50s, they're not as concerned because a lot of my clients tell me they're used to the, 5-6%, where the younger generation who's just getting in, this is all they saw was with these low interest rates.
Below 2.
Yeah.
Or below 3 at least.
Exactly. And we've got about, probably in the next 3 years, 70% of mortgages are coming up for renewal in Canada. And it's going to be a payment shock for sure.
I actually have a really good chart I can share. Because that's a great point to bring this up there. Let me just adjust this. We're so technical here that it's so... Yeah, so behind you, not sure if you could see that or not, but obviously you can't. But we have in 2024 insured over 336,000 mortgages are renewing this year, uninsured 722. And in 2025, there's going to be another 770 uninsured mortgages renewing, rated almost 400,000, almost 390 basically insured. So we're hitting that really tough spot right now where there are definitely a lot of mortgages coming up for renewal. And if I could share another chart, this is what's concerning to me, and I'm sure your clients. Right, so this is the Bank of Canada. So we're talking official charts here. Let me clean it up. I'm going to go what they've been used to basically. Now these are conventional mortgages, posted rates for conventional. So we know the rates are different, right? Mm-hmm. Typically, when a bank has a posted rate, very rare do you get the posted rate.
That's right. There's always they always get it. It's always discounted.
It's always discounted.
Yeah, it's always discounted. Usually,
at least 1%.
It depends. Yeah, a lot. Like I'm not quite sure how, because now I'm being in the broker and side of things. When we ask for rates, we're already getting the discounted rates. So a lot of the time when we're dealing with monolines, Monolines are different than your financial institutions, your big banks. Monolines just deal with mortgages only. And they don't, this is what's really, there's a benefit sometimes to dealing with a monoline, because monolines don't go by the posted rate. They already give you their discounted rates. And for example, I don't know, something unforeseeable could happen. Like in 3 years from now, you could unfortunately have a marital breakdown and you need to get out of a 5-year term.
Or a new job.
Or move or whatever it is, and they have to break their current term. Say they're in a 5-year term, they have to break it. The breakage cost will be dependent on their interest rate that they have.
Which is typically discounted compared to the posted rate.
Right, where like the banks will, the breakage cost is based on the posted rate. So their breakage cost will be a little higher than if you were to deal with a monoline. So it's sometimes is something you should think about when, whether you want to go with a traditional bank or if you want to go with a monoline lender, is that the breakage cost with the monoline will be a lot cheaper.
So the unexpected down the road, which a lot of people really don't plan for. They just assume let's take out a 5-year mortgage and let it ride, whatever the case is.
Yeah.
I'm going to bring up the prime rates. And I've always heard, since I got into actually, let's go back. This is 1980, right? Mm-hmm. Today's homeowners have no clue what it would be like. They wouldn't even be able to afford a 21% mortgage rate, right? That's what our parents had to go through, basically.
Yeah. I do remember working in the industry back in 96, and they were talking about in 1980. Back then, they did have people coming into the banks, dropping their keys off to the bank manager saying, I can't afford this anymore. It did happen in those times. So there were some tough times. And one of the differences, too, is our income, the purchasing power of our dollar, our income. So back then, even though interest rates were high, the prices of homes were quite lower. And so, the affordability aspect of that was greater. Whereas today, like some of the people that are coming to me, I think they're making great income, but you have to have these two people with good incomes in order to afford a home today, because prices of homes today are through the roof, really.
Mm-hmm. Yeah, so, they've increased significantly.
Yeah.
Even with the pullback we've seen over the last 2 years.
Mm-hmm. So we talk about rate, really 4%, 5%. That's actually pretty good. Yeah. That's a pretty good rate, except that it's not what happens is because the prices of homes are so high that to make it affordable, we need interest rates at like 2%.
Right.
You know what I mean?
Yeah, exactly. And I think those days are gone, though. Mm-hmm. Right? Unless something really bad happens. But like Tracy, when you're building a financial plan, I know you do you forecast. So if a client has a mortgage, which most younger people do, they have mortgages, or they have a line of credit, you build in, not stress tests, but like on renewal, if the mortgage was 3% a year or two ago, you were building in a renewal, maybe like a 4% mortgage to see if they could still carry it and things like that.
I normally build in 5% into their plan. That's the recommended interest rate.
Okay. Yeah. So that is just to make sure that their budgeting is in line, make sure that the affordability, that they'll be able to continue on. Right. So
right. And when someone's concerned that they're in a lower interest rate and it's going to renew in the next 2-3 years, I really suggest that they look at their mortgage payment. So if they're paying monthly, maybe pay bi-weekly or accelerated weekly payments so that they can chip away at the principal, so that when they renew, it's not so high of a payment. And also to budget for that higher mortgage payment now, so that you get used to setting funds aside so you can pay your mortgage down, or just getting used to that amount so it's not such a shock in 2 years.
Yeah, great strategy and great plan.
Very good.
Yeah, if we look at 2007, that's 2006. No, my wife's going to kill me. I think we bought our first house in 2006. Like our mortgage was 6%. I believe, around there, which was average.
Mm-hmm.
And even if we go like from 2000, 2010 all the way to 2020, right? Like the average mortgage was hovering around 5%. It's only recently that they've gone up. Like rates just kept coming down, right? In the prime, this is what like a lot of people are going through prime rate. It basically went to like just over 2%. So if you had a prime, like a variable rate mortgage, like the cash flow, a lot of people were paying very little in interest, but they weren't actually, a lot of people were just paying interest only.
Yeah, the Bank of Canada actually went to 0%. And so,
Which is unbelievable.
Yeah, which is unbelievable. So when they're 0%, then the banks are 2%, right? So what's happened is there's variable rate mortgages and there's adjustable rate mortgages. So a lot of people had like the same payment based on, say, 2% or at the time. And now when their mortgages are coming up for renewal because, the spike in the interest rate going up so high, their payment stayed the same. Now that affects their amortization. The one time I was doing a mortgage and I was asked for the mortgage statement, maybe to do a refinance, and saw that the amortization was like almost 100 years. It was like at 99.
That's insane.
Years. Yeah, that was so crazy.
It's negative.
I had never seen that before. But then again, I've also never seen the interest rate prime go up so much in 1 year like it did. Traditionally, the best way to go would be the variable rate, and history shows that. And you'd actually pay off your mortgage more if you were in a variable. But in this trend, this upward trend, has now people going into the fixed rates. I do believe that we're going to go back to the variable.
In popularity again?
I think so. I think right now the biggest trend is people taking short term from 1 to 3, maybe 1 to 4 year fixed. Even today, right now, it's still cheaper to take the fixed rate over the variable, because the variable right now is 6.7, and I think you can negotiate. I have seen 80 basis points below that.
Okay.
So
6.9 still?
6.7, so 5.
Oh, sorry.
Yeah. So then it would, so interest rates, like I've seen a 5-year mortgage insured. So if it's CMHC insured, you're looking at 4.69. I've seen
on a 5-year.
On a 5-year.
Well, that's fantastic. I actually think that's a decent rate.
I do too. I do too. I think that it's a great rate, but a lot of people are still very hesitant of going the 5-year. They're actually choosing to go 3-year at a higher interest rate. So you could do like 5. I've been seeing 5.19% for 3 years, 5.9 for 3 years. They'd rather do that than the 4.69, because they believe that in 3 years interest rates will be lower, and go from there. But I mean, if you take a variable now, as the rates continue to go down, you can always switch from your variable into a fixed rate, always, with your lender.
Excellent. And Tracy, are you, like, we don't tell people what mortgage terms to take, this and that, but are you giving them the options? This is a 3-year, this is a 5-year. This is where economics think rates will be in 3 years. And is it the same that they tend to go with the shorter term right now, with the expectation that they'll be able to renew?
I find that people are taking the shorter term. I present them with all their options and show them the interest expenses. And we try and make a plan that fits in their budget and their long-term plan. But I am giving them that advice that we do forecast that interest rates are going down. So based on this, it might impact your decision.
Okay.
But we present them with many different options that suit their needs.
And at the end of the day, it's what they're most comfortable with. Right? Okay, very good. Well, we've already talked about impact on buyers, renewals. So lots of good information there. It comes back to this: we are in a new environment, I think, when it comes to rising interest rates, and we'll see what happens to go forward. And I agree with Sherry Cooper, where they don't want to cut too fast, otherwise they might reignite inflation. And the Bank of Canada is actually in a really tough position right now, because if they lower rates too much and the Federal Reserve in the U.S. does not, our dollar is going to drop, right? So then, weaker buying power, importing is more expensive. It's great for exporters, but can you imagine traveling outside of Canada if we went back to the 60-something cent or whatever the case is, right? A lot of domestic traveling would be going on, but it's definitely a real risk that the Bank of Canada has today. It's like, how quickly can they come down based on the numbers? And unemployment is going up as well, so we're starting to see that. So I think they're trying to get ahead of the curve. But when we look at risks in the real estate mortgage market, just gonna share a couple articles here. This is what we see. This is an article put out by Urban Nation, right? So they have a lot of great charts on here. This one here is what I was referring to, or started to refer to, that construction of condos and even single-family homes has dropped off significantly. One of the reasons is because the cost of construction loans has gone up so much, right? So the lenders are asking for either more equity from the developers, right, or more pre-sales. But when you launch a condo, the pre-sales are going to investors for the majority, right? Because these condos won't be completed for another 2 to 3 years, if not longer, down the road. So it's really investors that are buying pre-construction in order to either flip it, if that even still exists today, or rent it out at that point in time. But with the uncertainty around rates, the cost of these new units, a lot of investors are actually today cash flow negative. And I have another beautiful chart to illustrate that. But these are the risks that we see, right? So construction loans have gone up significantly, so pre-construction condos sold like down over 50% since 2023, right? Pretty significant. Condo construction is dropping fast as well, right? So same thing. We are looking at a lot less units that are going to come onto the market in 4 years, 5 years, which I think is going to create a whole new problem, a whole new bunch of brand new problems for the Canadian housing market, right? Because if we don't continue to build, supply shrinks while the demand is still there, right? Our population is not shrinking. Our population is actually growing, right? So if you don't have enough supply, if we think housing is expensive today, man, I don't even know. Like in 2027 going forward, it's going to be very, very interesting at that point in time. And then we've got condo rents dropping as well, right? Because of affordability. So you're buying an investment property, interest rates are high, rents are down, you're cash flow negative, which it just doesn't add up, or it doesn't, it doesn't create a very good rental environment to be in. This is the, let me go over to, large increase in cash flow negative condos, right? So these are basically investors, like there's 81%, if you took out a mortgage in 2024, 84% or 81% of those investors are cash flow negative right now, which just takes away any incentive to go into the condo market as an investor. What was happening in 2022, 2021, 2022 at the peak was they were already cash flow negative, right? So here we could see that in 2022, on average, $200 negative per month. But real estate agents, love them or hate them, like, don't worry about the cash flow negative because it's going up every year, right? So you're building equity still. Well, that clearly didn't continue because we saw what happened to the condo market. So a lot of risks that I think are going to come out over the next few years, which will make it very challenging for you with in the mortgage space, challenging for Tracy and her financial planning, but definitely make it interesting overall. Any thoughts on what's going on, not going on? Like, what do you hear from your real estate buddies, Because you work with real estate agents.
I do work with many real estate agents, and I know that the condo market in Toronto is really bad. I haven't seen the effects of it here in Kitchener-Waterloo as much. I think because of the nature of our community being a lot like tech, we have Google,
Yeah.
and so a lot of those Google professionals really love their condos.
We have 2 universities, a college,
Yeah.
2 just in Waterloo, Kitchener, 2 hospitals, and they have a hospital in Kitchener and Cambridge. Then we're building a new hospital. We're in a great little triangle here, right?
Yeah.
The Golden Triangle.
We are, and I really haven't seen too much of an impact.
Even in rents, which is interesting. Rents, we said rents are coming down, but not in Waterloo.
No.
Year over year, rents for 1 bedroom, 2 bedroom, 3 bedroom are actually up. Right. So we are kind of in our own little pocket here.
Yeah. So, but that I haven't really, seen it hasn't impacted any of my
Your business,
the deals that I've been doing in regards to condos. Single detached homes. I found that we had quiet spring, as we're used to a really busy spring market, and it was a little soft to say, but I've seen in the last 2 weeks it's really picked up.
Okay.
So getting a lot of pre-approvals coming in, houses going up, clients that are putting my house up for sale, and then it's selling in 4 days. So we've seen a little bit more action lately. So
do you think that's related to the recent Bank of Canada rate cut? People get excited again. They try to get in front of the, they're expecting values to start going up again and get a head start or jump ahead.
It's probably a combination of both. I just know that we've seen a surge in applications and approvals and so forth. So, and sales. So I think that we're even going to see even more of that in the fall, because the next Bank of Canada announcement is going to be September 4th. So if that goes down another, I think we're going to see a busier fall than we did in the spring. So it has a lot to do with the Bank of Canada.
And expectations to cut rates. Things like that.
Yeah.
What was a 5-year mortgage about a year ago? On average, I know putting you on the spot right here. On average,
so I'm just thinking that last year I was placing a lot of mortgage. My job is to find the cheapest rate for the client. So last year I found that working with TD, they were doing, their interest rates were quite low. We were able to place a lot of mortgages with them, and I would say in the spring to close in the summer, I was doing maybe it was 4.49 for 5 years.
Last year
was TD.
It was lower last year than this year.
Yeah, and then it started to go. I'm talking about fixed rates.
Fixed rate, yes.
So I'm talking about fixed rates, not the variable.
No, exactly.
So, and I noticed that the fixed rates, in the spring of last year, the rates were down. And then it hit, when it was about June or July, then fixed rates started going back up again. And that's what my experience this year. I say Scotiabank is giving out pretty good rates right now. I don't know for how long, but they're doing really well. So I can't recall the exact rate, what the posted rate was. I don't know, but I know that I did a lot at 4.49% before June of last year.
The only reason I bring that up, I have, this is a live feed, right? So we're in wealth management. I'm a portfolio manager. Tracy's a planner. And I basically don't stare at these things all day long, but we monitor the markets, right? So interest rates are so important. And a bunch of other stuff. But so this is a live feed. I paused it, but we could see, so what's happening now. So the last column here, this is the current yield on Government of Canada bonds for 30-year at the bottom up to 3 months, right? And right now we've got an inverted yield curve, which is not normal. It's signaling a recession, and it means that borrowers are not willing to take on risk short term, so they want to get paid more short term than they do longer term. Right. And this is what impacts that 5-year fixed, right? It's not the Bank of Canada overnight rate, right? That impacts a variable rate, but the fixed rate mortgages are a direct reflection of the
bond yield.
Yeah. Right. And what's interesting, like, so today a 5-year is 3.22. But on a year-to-date basis, it's up. Like, it's actually more expensive today, this morning, than it was January 1st. But if we go back 12 months, it's actually down 18% over the last 12 months, right? So it's interesting that the 5-year today is more expensive than what it was 12 months ago. Right? Because
that's what I was just saying, because I remember last year I gave somebody like a 4.49%, and this year the best I can do is 4.69. So it's still a little higher this year than it was last year. But I found that the first 6 months were okay, and then the last 6 months of the year of last year, things started to get a little expensive. Creep up again. Sure. And then all of a sudden, I remember August, home sales, everything it froze, like it just stopped, and people, like, before you put your house up on the market, it would sell like that. Then all of a sudden, from about August till, I would say, till almost January, it was stagnant. Like we just saw like a big, huge pause. And then, it started creeping up in February, and people started to again. So we're, what do you call that?
Unknown territory.
Uncharted territories. Like, it's so hard to figure out what's going to happen. And I remember buying my first home in 1994. So in 1994, I bought it for $130,000. 6 years later, I want to sell it, and my realtor comes by, does a review, whatever, and says, "Okay, we'll list it at $135." And I
went backwards.
It just went up by $5,000. And I
sorry.
Yeah. So I looked at her and I'm like, "How is that possible? I've lived here for 5 years, and all I've made is $5,000. That doesn't even pay for commission to pay you. Like, I'm going to lose money." On my, and so I remember thinking, this is ridiculous. I'm like, I couldn't believe it. But I did list it. I asked to list it a little higher just to see what I would get. But really, this is where it comes into play, where your home is only worth what someone's willing to pay for it. So, she told me 135. I wanted to list it at 140, I think it was 145 or 149. I can't remember exactly. And she's like, "Well, it's going to sit there. It'll sit on the market for a long time." And I said, "Well, if it doesn't sell, then I'll just take it off the market. That's all I'm going to do." Mm-hmm. So I let it, and within a week, I had an offer, and they took it. Like, I think I sold it for 145. And basically, again, it's who walks in, who falls in love with your home. If they really want it, they'll pay for it, right? So your home is only worth what someone thinks.
But that's a normal real estate market, right? Where it just goes up with inflation, basically. If inflation,
that was like 6 years.
Yeah. So, but what we experienced, the last 10 years, it's not normal.
No.
Right? It's actually dangerous.
No, because the first time I bought my house, basically I didn't make any money. I didn't make a lot of money, to be honest. The second house I bought for $215,000, and I lived in it for 14 years, and I sold it for $450,000.
And the $200,000 home was, describe it compared to what you would get. Well, you can't even buy it for $200,000.
Well, today that house is worth over $1 million.
Yeah.
Yeah. That it's.
Yeah, really, it's just really.
Then afterwards, I started to, how it started to impact was that I think in 2016, 2017, I started to see where a lot of people were moving from Toronto to this area. Mm-hmm. And the bidding wars that went on, we're talking 100,000, 150, 200,000 over asking price. And it just inflated housing values in this area.
Those people are managing that debt when they bought at the peak on variable rate. or they went and bought cottages or rental properties, and then the interest rate shot up. How is it impacting them? Are they starting to sell off their properties, or are they refinancing more?
Some of them are selling them at a loss. Some of them.
So there was equity in it, though, for you to sell at a loss.
You have to, definitely would have to have equity in it. But to be honest, being in my industry, I haven't seen too much of that. Like, I would have thought that I was going to see a lot of it, and I haven't. I think there's a lot of people that are that buy and hold. I think they're holding on, and I've only seen a few that maybe are thinking of selling and have sold. But and you made a good point to me the other day where financial institutions are working with their borrowers to see if they can extend amortization. People, at the end of the day, lenders want to keep their clients in their homes. So they're going to be working with clients to make sure that the affordability is there. Sometimes there's programs that they have where they can skip a payment if they need to. Like, if there's a tight month, they can skip a payment. So I haven't seen the downfall to that yet. I don't know if it's coming. I don't know.
Yeah, there's a misconception that a lot of people think the banks will foreclose
right away.
No, they don't want to do that.
No, they don't want to do that.
Banks and other lending institutions, they're in the business of lending, not of foreclosing, right? So now the extend and forget, that's what I call it. When you extend the amortization and you actually go negative, like, you almost have to crystallize the interest cost, so you're not actually paying down any equity. I think that's horrible for the homeowner. So it's good for the bank or the lender because their interest revenue is definitely increasing. But there isn't a whole lot of that in Canada, I don't believe. I think there wasn't a whole lot that took place, so I don't think there's going to be major implications from that. But it's definitely interesting to see what will happen going forward.
Yeah, but interest rates now are heading downward. That's a positive thing. Yeah. And for it to go down and by the end of 2025, another 200 points, that's
if it happens.
Yeah, if it happens,
that'll be significant.
I think it's going to happen. I think it has to happen. That's what I think. And with you, I'm not sure, your perspective of that, sooner than later, or more than, the cuts are deeper. But again, we're kind of afraid. Bank of Canada is afraid because we don't want, exactly.
Yeah, so central banks around the world, not just Canada, the US, they don't want to repeat what happened in the 80s, where rates went up. They brought inflation under control. They quickly cut, and inflation came back, and then they had to raise again, where you got that 20% mortgage. They don't want to repeat that, right? So I think they really want to try to create a soft landing. The U.S. looks like they're in a soft landing. Canada, not so much.
Yeah, and remember we talked about the market in Canada, the mortgage market is completely different. They have 30-year mortgages.
Terms. 30-year term.
Exactly. Yeah. So when interest rates were low, they're going to lock in, right? And they could refinance without penalty. Yeah, that's amazing. So as rates were dropping, they just kept rolling it over into a lower. I don't understand why we don't have that here. Why can't we have that here? That's what I wish we could have that. But anyway, it keeps me busy. But and that's another issue too in the U.S. where people, if they have these mortgages, why would they want to sell and get out? They don't. And that's exactly what's happening. Yeah. Right. So the resale market has basically not dried up, but it's definitely slowed down. All the inventory was coming from builders because they were able to build. But you're right. If I'm in, a 30-year mortgage at 2.25% or 3%, whatever it is, and rates in the U.S. are 7% now, right? A 30-year mortgage is 7%. There's absolutely no way, unless I absolutely had to, that I'm going to sell my home to upgrade or upsize or downsize. Going to go from a 3 to a 7. They just sat. They just froze, right? They didn't move. So builders are the ones creating the inventory. Yeah. So our economy they're it's totally different. Yeah.
Absolutely. I just wanted to ask Tracy and both you and Phil about current trends or like what you're doing to help you, like for some home buyers as an example, or do you see trends? What trends do you see taking place?
Well, with first-time home buyers, really, I've been seeing a lot of the down payments being gifted. So gifted down payments from parents is one of the trends. The other trend is short-term, like it's going to be from 1 to 3 year fixed. They're not going long, they're not doing 5.
So they're expecting shorter, lower rates within the near future, and parents are gifting down payments.
And also certain families have decided to buy homes together. So you've got multi-generational people.
It's going back to the 50s, 60s, and 70s where immigrants came over, like being Portuguese. I shared a room with my grandmother and my brother for a short period of time, right? And before we were able to upgrade, like upsize and stuff. How about you, Tracy? With our clients, we haven't seen a lot of our clients withdraw to gift to their kids. Some
I've seen a couple. So the trends I'm seeing are parents are building and gifting for their kids to buy a home within their retirement plan. So pre-retirees are saying, I want to gift my child $100,000 in 5-10 years so that they can buy their first home, and I'm building that into their plan. I'm also seeing them either pull out from their investments or leveraging the equity in their home to be able to gift a larger down payment to their kids. A lot of them want to give while they're living so that they can see the benefit of their gift while they're alive rather than waiting until they pass away and their kids benefit from the inheritance. A couple of ways that they're doing that, either parents or grandparents, is they're giving their kids smaller amounts more frequently to top up TFSAs or FHSAs so that they are able to
purchase. What's an FHSA for those that don't know?
An FHSA is the first home savings account, and a TFSA is a tax-free savings account. So they're telling their kids, don't worry about maximizing those accounts. We'll top them up for you. It's a great way to kind of keep some control over that gift to make sure that it's used prudently and responsibly. They're able to provide guidance and they're able to give their kids financial literacy. It's way easier to see what someone's going to do with $7,000 or $8,000 versus $70,000 or $80,000. So you can manage your expectations there.
So there's gifting while alive.
Oh, yeah.
Right, which I'm a big fan of, to be honest with you. I rather see my kids benefit from my gifts while I can, right? To see, than when I'm gone and they don't need it at that point in time, right? Because if let's say I die at 80, really at 55 or whatever it is, 60, I'm trying to think how old my kids are compared to me. Like I'm a lot older than them, right? Or when I'm 90 and they're 60 or something like that. What's the point? They don't need your help at that point in time, right? Or a lot of them don't, right? So by gifting today,
you're also very good, like tricks, knowing all about taxes. So if I have a client who owns a rental property, and now they've decided I want to give this rental property to my child. Or, for example, let's say you've got a mom and dad and a child on title. The parents are the ones that bought it. The parents are the ones that are paying the mortgage. The child just has her name there on title. Now the parents are saying, okay, we want to give this. We want her to take this over. So she's going to take over the mortgage. She's going to take over everything. Is there a tax implication there? Is it capital gains?
Yeah, it's a deemed disposition, right? So if you transfer the ownership from one person to another.
But if she's already on there, say she's already on title, now from day one, and we're just ripping mom and dad off, and she's staying on title. But because she's not paying the mortgage, now I got to qualify her on her own.
Yeah, it depends on how it was originally set up, right? So that's a tax question, and we don't give tax advice, right? We bring in the tax experts. But we. Yeah, okay. There's ways to set it up properly, but it is a deemed disposition, right? Especially if you're taking, so if there's 3 people named, typically it's 1/3 ownership each. And now you're transferring 2/3 to one. Those 2 are selling.
And I'm just thinking probably that the daughter will probably have to pay land transfer tax on that.
That I don't know.
No, it's a title transfer.
It's
Title transfer, she doesn't have to, because okay, so I'm just trying to think who paid the title insurance at the beginning.
They all did.
They all did.
They all did, right? Yeah.
Okay.
But in that, that's a deeper conversation around tax planning and financial planning, what Tracy looks at. We've had client structure, like if it's multifamily, and Tracy knows this better than I do because I'm not a planner, portfolio manager. Tracy's a planner. Just setting up a whole core, doing a freeze type of thing where you could transfer over a number of years so you minimize the taxes. And now we just got that new capital gains update, right? So it's even higher today. But that's so from Tracy, first home savings accounts, FHSA. Okay, are they popular?
The first home savings account is quite popular. They're awesome. The FHSA was introduced in 2023 to allow first-time home buyers a way to save for their first home. It kind of works like an RSP and a TFSA. It has the best of both worlds. So it gives you a tax deduction like an RSP, but the funds can grow tax-free if it's used for your first home, a qualifying first home, like a TFSA, and you can withdraw the funds tax-free. If you don't use the money to buy a home in the first 15 years, you can roll it over to your RSP tax-free, tax-deferred, or if you want to withdraw the funds, it'll be taxable. So it's a great way to save for your first home. The key is contribution room only accumulates once the account is opened. So that's the difference between an FHSA and RSP and TFSA, where an RSP and TFSA, the contribution room automatically accumulates, but an FHSA, you have to open the account and then the room starts to grow.
Even if there's 0 in it, you don't have to make a deposit.
That's right.
Is there a maximum every year that you can put in there?
Yeah, the maximum is $8,000 a year to a lifetime max of $40,000.
Okay.
That's where we see parents' income splitting, kind of, right? If we call it that, it's like taking that $8,000 out of their hands, gifting it to the kids. So it's cash, right? So there's no attribution rules. They gift $8,000 and the kids put it into the first home savings account. So
and it gives them the tax deduction as well. So we can do some proper planning there where we open the FHSA maybe when they're 18 or 19. They might still be in school. We let the accumulation room grow. And then we kind of do the contributions for some tax planning for the child. And a great way for them to save towards their goals without impacting their cash flow is using the tax refund that the FHSA creates and just save it in a TFSA or make more RSP contributions. It's a great way to save towards your goals without impacting your cash flow.
So planning, budgeting, all important parts of it.
Yeah, and it's great skills to have, especially for your whole life. You need to save and budget and plan. So it's a great way to save for your goals, both now and in the future.
Good. Great points. Phil, thank you. Anything you'd like to add?
I'm just happy that you invited me here today. Thank you so much.
Problem.
I've actually learned quite a lot from you guys.
Great. Hopefully we can have you back.
Yes.
Fantastic. Thank you, Phil.
Thank you.
Thank you, Tracy.
Oh, thanks.